let us try to do a recap of our last class. Our last class, we are looking at capital reconstruction. We explain what is capital reconstruction, the purpose of capital reconstruction, the principles of capital reconstruction, and we discuss the steps involved when you are faced with a reconstruction question. Now, what is capital reconstruction? We are just trying to do a recap for like 10 minutes, 15 minutes. Why others join the class? We define capital reconstruction as a major reorganization of a company capital structure. Capital reconstruction is a major reorganization of a company's capital structure. This is usually done when a company is in financial crisis or financial difficulties, and the possibility of eventual collapse is very high. When a company faces the risk of financial collapse or liquidation, that implies that the company in question is facing financial crisis. It is the duty of the company's directors to decide on how to save the company from eventual collapse. Please, can you mute? Christina, please, can we mute? Thank you. Is it the duty of, Anthony, please, can you mute? It is the duty of the company's directors to find a way on how to save the company from eventual collapse. There are several actions that could be taken when a company is faced with financial crisis. There are several actions that could be taken. One of them is capital reconstruction. This capital reconstruction might involve asset revaluation, introduction of additional capital to the business, conversion of debt capital to equity. It can also involve reclassification of equity shares, and the existing shareholders may be required to relinquish part of their shares and accept a smaller quantity of shares in the reconstructed company. We explained this in our last class. And we said the purpose of capital reconstruction is to find a way to allow the company to continue in business and avoid liquidation. The objective of capital reconstruction. The objective of capital reconstruction is to find a way to allow the company to continue in business and avoid liquidation. We explained this. We look at the principles of capital reconstruction, and we said at any point in time you are faced with questions on reconstruction, and you are being asked to analyze or to evaluate a reconstruction scheme, you are going to be comparing two positions. If you are faced with question on capital reconstruction and you are being required to evaluate a reconstruction scheme, you shall consider two positions. Position one, if the company is reconstructed as suggested by the directors. And position two, if the company is liquidated. You are going to be comparing these two positions. We explain this. We talk about the principles. There are three principles of capital reconstruction. These principles are: one, creditors must not be made worse off under reconstruction. Creditors should not be made worse off under reconstruction than they will be under liquidation. Number two, we have to consider post-reconstruction financial viability. That is, if a company is reconstructed, then there must be possibility that that company can return itself back. That company in question can restore itself back to profitability. Then number three principles, you have to consider the principle of fairness. Reconstruction should be fair to parties involved. We look at the steps of capital reconstruction. We have like 6 steps involved. Step number one is that you must be mindful of the fundamental principles of capital reconstruction. You must bear in mind the 3 principles of capital reconstruction. Number 2, you are going to consider situation in liquidation. If the company is liquidated and the assets realized, how will the proceeds be distributed? That is, who gets what in the event of company being liquidated? Remember, we emphasize that if a company is liquidated and the asset realized, any money generated from the realized assets or from the liquidated assets cannot be distributed based on our intuition or our personal opinion. The law specifies how the proceeds of liquidated assets should be distributed. We explained this in our last class. Then step number 3, we talk about capital adequacy or cash adequacy. Step number 4, we talk about post-financial profitability, post-reconstruction financial profitability. Step number 5, then you are going to do the evaluation of the reconstruction. At this point, you are going to try to evaluate if the reconstruction scheme is fair. Then your step number 6, you are going to draw your conclusion and make your recommendation. These are the discussion we had in our last class. Thereafter, we solve a question. We address a question at our last class. Tonight, all things being equal, we shall be rounding up this topic. And we are looking at question number 2, Able Bank PSC. This question is available on the study pack, page 124 of the study pack, illustration 2. All right. We have done a recap of the last class. We now move to today's question. If there's no question from the students, then we move to question number 2. Any question, please? All right, let's go to illustration 2. I'll read. Able Bank on April 24, 2019 received the following statement of financial position. Prepare for its customer. It should be one customer. For its customer, Pecon Limited. Let us look at the statements of financial position. As at April 20, 2019. Freehold property at cost 20 million. Plants carrying amount 172 million. Current assets inventory 67 million. Receivable 62 million. Total asset is given. Equity. Issue share capital 1 naira each, 50 million. Reserves 23 million. Non-current liabilities 10% loan notes. Please note, loan notes is a form of bond, usually for a medium-term period. So loan note is a debt. You can have bond, debentures, loan stock, loan notes. They perform the same function. They are all debt instruments. Please, you can mute if your speaker will disturb the class. All right. Examiner say non-current liabilities 10% loan notes in bracket secured on freehold property. This was 50 million. Now, if you look at this, let's explain that briefly. A liability is secured on a particular asset of the company. This is fees charge. This is what fees charge. It is not impossible that you are going to deal with a question from this environment these days. It's been a while this environment was tested. Where a liability is secured on a particular asset of a company, then you have what we call fees charge. So please note this. Current liabilities, bank overdraft 45 million, sundry payables 117 million. Next paragraph. PL is a long-established company which traded profitably until a few years ago. Following the expiration of exclusive patent rights on a particularly profitable product line, results declined dramatically over the last 12 months. The company's cash flow problems have steadily increased. The overdraft facility at present stands at 45 million and carries a second charge on the company's freehold property. Please note this statement. Overdraft is a liability. Loan note is a liability. Now, we now have two liabilities. Two liabilities are secured on the same asset, property, freehold property. But when we have first charge, then we have second charge. All right? A meeting has been arranged to consider the company's future. The above statement of financial position will be presented at the meeting, and the following proposals will be discussed. Proposal 1, immediate liquidation of the company. Full stop. In these circumstances, it is estimated that the freehold property will realize 65 million. The plant realize 21 million. Inventory 40 million. The receivables will pay up in full. Preferential payables. Please, can you mute? Chidima, please, can you mute? This one. Included preferential payables included in the statement of financial position figure for payable amounted to 27 million. That means our payable figures include preferential payables. Your preferential payables are the preferential creditors. All right. Proposal number 2, Tire Limited. Tire Limited has made an offer to take over the entire business activities of PL. Under the terms of the offer, Able Bank will receive 80% of the balance due, but repayments would not be made until exactly 1 year from the date of the creditors' meeting. No further interest will be considered to accrue on the balance due to Able Bank during the last 12 months, during the 12-month period. Now, proposal 3, reorganization and capital reconstruction. The management of PL is planning a reorganization of the company's activities, which will restore profitability to reasonable levels almost immediately. The reorganization will be linked with a capital reconstruction scheme. Under this scheme, the existing shareholders will be asked to accept 2 1 naira shares in exchange for every 5 shares currently held. You are going to be asked to accept 2 shares in exchange for every 5 shares currently held. That means number of shares will reduce. The bank will be asked to accept 10 million 1 naira shares as consideration for 1/2 of the present overdraft. If this proposal is acceptable to the creditors, the shareholders have indicated their willingness to take up a further 30 million 1 naira shares for cash. And the balance remaining outstanding to the bank will be repaid from the proceeds of this issue. The directors are confident that if this proposal is put into effect, a profit of 40,500,000 per annum will be earned for the foreseeable future, of which 2/3 will be paid out as dividends and the remainder reinvested. Note, assume that the bank earns 15% per annum on all its lending, and that the amounts in the statement of financial position include interest that accrued to date. Assume for convenience that any adopted proposal will be implemented immediately, with payment received immediately, unless otherwise stated. Ignore expenses of realization and liquidation, and assume that no changes have occurred between April 20 and April 24. Requirements. Requirement A. Calculate the amounts which Able Bank will receive under each of the 3 proposals. Look at requirement 1. Calculate the amount which Able Bank will receive under each of the proposals. So you are going to look at proposal 1, immediate liquidation. Now, if this company is liquidated, how much will Able Bank receive? When you are done with that, you go to proposal 2. Proposal 2, Tayo Limited takeover. If Tayo Limited should take over the company, how much will Able Bank receive? Proposal 3, reorganization and capital reconstruction. If the company is reconstructed and reorganized as proposed, how much will Able Bank receive? Now, if you compare this question with the first question we saw, this question is about a stakeholder bank Able Bank has given, or Able Bank has granted overdraft facility to a customer. The overdraft facility is 45 million naira. Now, this customer in question, that is Pecon Limited. Chiamaka, please, can you mute? Can you mute? This customer in question is facing financial crisis. And the customer or the company is considering 3 proposals. All right. We have tried to explain the question to ourselves so that when we get to our solution page, that will enhance understanding, all things being equal. All right. Any question from this before we move to the solution aspects? Any question, please? Please, occasionally, please check your speaker. We don't disturb the class. But if you have a question, you can always raise up your hand to speak, or you can send your question or comment via chat. Now we move to solution page. Like I usually advise, you can write, if you're in the class, it's not a crime. Proposal A. Immediate liquidation. The liquidation immediate liquidation. Now, if the company is liquidated, how much can we realize from the sale of the company's assets? Let's look at the question. Let's look at our question if you have the question, and we should have the question anyway. That's proposal A. If the company is liquidated, it is estimated that the freehold property will realize 65 million. Plant and machinery realize 21 million. Inventory 40 million. Receivable will pay off in full. So pick this figure. The first one, freehold property, we keep that aside. First, plants. We are going to realize 21 million. Is that not? Inventory, how much, please?
$40.
Inventory 40 million. Thank you. Receivables we pay off in full. What is the value of our receivables, please?
26 million.
26 million. Please sum this up. Total amount realized from these 3 assets.
It's 7 million.
Total amount 87 million. Now, some of us may be wondering, or may wonder, why are we not taking freehold property? Why are we not taking freehold property? The 65 million. Now, this property or this asset has been used as a collateral for two liabilities. Recall, in the course of reading the question, I explained that where a liability or liabilities are secured on a particular asset of the company, that is fixed charge. In the event that the company is liquidated, any money realized from that asset must be applied directly to the liability or liability tied to the asset. When you are faced with question on reconstruction, you are going to watch out for fixed charge. So we are going to pick this. We have freehold property. The amount realized on this property is 65 million naira. This asset has been used as collateral for two liabilities. But one liability is the fixed. If you go back to that statement, examiner says under non-current liabilities, 10% loan note secured on freehold property. That means loan note, we have the first charge. We have realized 65 million now. We now come to settlement. We realize 65 million from property. We realize 87 million from other assets. We now come to distribution. Now, if a company is liquidated and the asset realized, how do we distribute the proceeds? Who will collect first? You can unmute and speak.
Debt holder.
Fixed charge.
Who are the debt holders now? Yes, who is speaking?
10% loan notes.
Secured creditors.
Secure creditors.
Yes, sir.
Okay. Which type of secure creditors?
Fixed. Like the 10% loan notes that is fixed. On
Thank you. That is fees charge secure creditors. We are going to start with the fees charge. First charge. First charge. We have 10% loan note. What is the value of the loan notes, please?
50 million.
That means we are going to settle this from 65 million because this loan note is secured on freehold property. Out of 65 million, we are going to settle 50 million. We are left with what, please? 15 million, obviously. We come here. We have 15 million remaining. Now, this question now says overdraft facility. Let's go to that aspect of the question. Look at it, please. Then. The overdraft facility at present stands at 45 million and carries a second charge on the company's freehold property. That means when you settle the 10% loan notes fully, any balance remaining will be applied to settle overdraft facility. Now the balance remaining is 15 million naira. That means this 15 million naira, we are going to settle second charge. Second charge. Bank overdraft. Bank overdraft is 45 million. We only have 15 million. And the bank overdraft is 45 million. That means there's an outstanding balance. Is that not, please? Outstanding overdraft balance. This will give us 30 million. Now the question is, how would the bank claim this 30 million? Bank has gotten 15 million. How would the bank claim this 30 million? Yes, anybody? Hello?
They will become like other unsecured creditors.
Thank you. They will now go and join other unsecured creditors in order to claim this balance. That means bank becomes unsecured creditors now. Once the asset is not sufficient, that particular asset, the asset in question now is the property. The property is not sufficient to settle bank. We have settled loan notes. The balance remaining from properties is not sufficient to settle bank. Then we are going to give the 15 million to bank. That 30 million outstanding, bank will now go and rank. Look at the comment. I'm going to put that comment there. You put a comment and said, look at the comments. Bank we rank alongside other unsecured creditors so as to claim the outstanding balance of 30 million. You are going to put these comments in your note. So we have settled, we are assuming that the company is liquidated. Oh. Please, sorry. All right, let's continue with the class. So we now follow order distribution. We have settled fees charge. The first person that will collect money when a company is liquidated is fees charge secure creditor. We have settled the fees charge secure creditors. Who is the next person, please? After fees charge, who is the next? after fees charge, who collects next? We still have 87 million to share.
Is it preferential payables?
So who is speaking? Let me put a name to this voice.
Preferential credit.
Okay, Eno.
Yes, sir.
That's thank you. Preferential creditors, preferential payables. Once you settle your fees charge, secure creditors, the next person is the preferential creditors. Who are these creditors? Unpaid taxes, unpaid pensions, unpaid wages and salaries. Examiner can take the same question. Examiner can repeat this question for you. The examiner will just remove preferential creditors. He will now introduce unpaid taxes, unpaid pensions, unpaid salaries and wages. Your duty then will be to sum these three together. These three will now form your what? Total preferential creditors. All right, we move to the question. Or we continue with the question. You now come here. We have 87 million remaining. Total realization or total amounts realized from other assets. This is, I'll put it here, 87 million. You now take your preferential payables, How much is it, please?
27 million.
27 million. We are going to settle this. We are left with, no, this is too much. It's not straight. We have 60 million remaining. Okay. That means you are done with preferential pay. Who is next to collect money? We are waiting. Oh,
Floating charge, if there's any.
sorry, I can't hear you. Sorry. Yes, you mentioned something. Yes. I think that line is off. Who is next for distribution? Let me look at this. Okay. Yes, floating charge, if any. Thank you. In this question, we don't have floating charge. In this question, there is no floating charge. After floating charge, we move to redundancy payments. Redundancy payment is number 4. In this question, there is no redundancy payment. Then number 5 is unsecured creditors. Number 5 is unsecured creditors. So let's go to it. Go and look at the statement of financial position. Pick your unsecured creditors. One we have sundry payables. How much is it?
$90 million.
Okay, you come here. Total unsecured creditors we have one. Sundry, no, I'll call it other sundry payables.
What's it, Joe?
Other sundry payable. Please, can you mute? You are conflicting the class, please. Other sundry payable. If you look at the statement we are giving, examiner says sundry payables is 170 million. The sundry payables is 170 million. However, these sundry payables include preferential payables, which is 27 million. That means our other sundry payables should be 170 million minus 27 million preferential payables. That means other sundry payables is 90 million. Is that clear, please? Is that clear, please?
Yes, sir.
Please feel free to ask questions. The total sundry payables is 117 million. Included in the sundry payable figure is preferential creditors, which is 27 million. And we have settled preferential creditors. That means you are not going to take other sundry payables. You are going to net off 27 million from 117 million. All right. Now check. Do we still have other unsecured creditors in this question? Yes. We have bank overdraft, the balance. Bank overdraft outstanding. The bank overdraft outstanding, no, like this. No. Remember this. 30 million. Look at this, where it's coming from. This balance. Bank will rank alongside other unsecured creditors so as to claim the outstanding balance. That means bank is now part of unsecured creditors for that 30 million. Total unsecured creditors, we have 120 million. The cash remaining is 60 million. This is the balance remaining. And we need to settle 120 million. Obviously, 60 million will not be sufficient to pay 120 million. How do we now go about it? Now come here, look at it. The balance of 60 million the available balance of 60 million will be shared between the creditors. No, between the unsecured creditors. Between the secure creditors as follows. Look at this. Other sundry payables, we collect other sundry payables. We receive, we have 90 here. 90 million divided by 120 million multiplied by cash available for distribution, 60 million. Please work this out. Other sundry payable we receive how much? How much, please? Is that correct?
Yes.
Yes, sir.
Okay, please try to be part of the class. You know, I cannot see the student from here, but it's only when you speak I know that here the class is actually. Then we have bank overdraft, balance. We receive, we have 30 million over 120 million. Multiply by 60 million cash available. How much we bank collect from here? That should be 15 million.
15.
Thank you. So if the company is liquidated, how much will Able Bank collect here? Look at it. In summary, Able Bank will receive, one is going to get proceed of freehold property, in bracket, that is the balance.
15 million.
Is going to get 15 million for a year. Bank will also get 50 million as share as unsecured creditor. Bank will also get additional 15 million. That means total amount bank will get. No, I don't like when this is not straight. Total amount the bank will get if the company is liquidated, that is proposal 1. Bank will get 30 million naira if the company is liquidated, which is proposal 1. You are done with
Sir, please, I have
proposal
a
1.
question.
Please go ahead. Who is speaking?
Eno.
Okay, no.
Yes, sir. So please, how do we know that it's not the bank that has the 10% loan note?
Okay, great question. When we say loan notes is a form of debentures. Loan note is a form of bond. Is that clear, please? Now, a bond or a loan note, these are debt instruments issued by the company to borrow money. It is not coming from bank.
Okay, sir.
Is that clear, please?
Yes,
if you
sir.
get to question, if you see usually loan notes, loan stock, debentures, bond, they are long-term instruments. They are long-term debt instruments. This will always appear in your long-term liability. Is that clear, man?
Yes, sir. Thank you, sir.
All right, that's a good question, because anybody can just assume that loan note is given by the bank. Loan note is not coming from bank. It's a debt instrument issued by a company in order to borrow money. Investors cannot subscribe for this debt instrument. Just like when a company issues shares, we subscribe for company shares. You can also subscribe for loan notes. The note will specify that you have given a loan to a customer, and the repayment terms will be stated on that loan note. All right. Any other question, please? If there's no question, we move to proposal 2. Please, each proposal will be treated independently. You know, you cannot the company cannot do 2 at the same time. It is either the company is liquidated or the company is taken over or the company is reconstructed. So you cannot do 2 proposals together. So we have assumed the first one. If the company is liquidated, the amount Able Bank will collect is 30 million naira. We now move to proposal B. Proposal B. Tayo Limited take over. Let's go back to that proposal and read again. Look at proposal B. Tayo Limited has made an offer to take over the entire business activities of PL. Under the terms of the offer, please just 1 minute. All right, let's go on. Under the terms of the offer, Able Bank will receive 80% of the balance due, but repayments will not be made until exactly 1 year from the date of the creditors' meeting. Okay. No further interest will be considered to accrue on the balance due to Able Bank during the 12-month period. So the question will be, what is the balance due to Able Bank?
That's the 45 million.
Thank you. The balance due to Able Bank is 45 million naira. The bank has given an overdraft to the company. And the total amount of that overdraft with the interest included is 45 million. So we just simply go back to this. Able Bank will collect 80% of 45 million naira. Under proposal B, just come here and say, Able Bank will receive 80% of 45 million. Let me shorten this. This is equal to 80% of 45 million. Please compute. I think 36 million.
36 million.
36 million. But the bank will have to wait for 1 year. Is that not? $36 million after 1 year. Look at proposal B. We are done. Proposal A, bank will collect 30 million immediately. If the company is liquidated, liquidate the company, dispose the assets, banks collect 30 million immediately. Now, proposal B, bank will collect 80% of 45 million. That's 36 million. But the bank will have to wait for 1 year. All right. Proposal C. Proposal C. Reorganization and capital reconstruction. Let's look at this proposal. Let's go back to proposal C. Okay. We take the reading again. Reorganization and capital reconstruction. The management of PL is planning a reorganization of the company's activities, which will restore profitability to reasonable levels almost immediately. The reorganization will be linked with the capital reconstruction, scheme. Under this scheme, the existing shareholders will be asked to accept 2 shares, 2 1 naira shares in exchange for every 5 shares in existence. In exchange for every 5 shares currently held. Okay, let's pause there. How many shares do we have in this company currently? Please look at the statement of financial position and tell us.
$50 million.
50 million shares. Thank you. Now the question says, under this reorganization, Existing shareholder will be asked to accept 2 shares in exchange for every 5 shares. That means number of shares will reduce. Let's go to this. Let's put this into working. It's too much. Okay. Come here. You start your working. Share capital account. We have the quantity, we have the price, and we have the value. Existing shares, we have 50,000. We are assuming 30 up. Price per share, 1 naira. Therefore, the value 50,000 also. 30 up. So we now do existing shareholder will be asked to collect 2 for every 5 shares. Just come here and do like this. Look at it. Just do like this. I will reclassify the shares. Let me close this. I want to reclassify the shares. That means a new shares becomes that will become I will put this here. It becomes 2/5. That we call it share reclassification. I'll call it reclassification. Share reclassified. That will now be 2/5 multiplied by 50. What do you have now? The share will now be 20 million. Price will not change. Then value will be 20 million. What this means is that 30 million naira worth of shares has been written off. I hope this point is clear. 30 million naira worth of shares. Examiner says existing shareholders will be asked to accept 2 shares in exchange for every 5 shares. That means number of shares will reduce. We call it share reclassification. Shares that worth 50 million naira has been reduced to worth 20 million naira. Is that clear, please? Is that point clear, please? So we have treated defect 1. Yes, correct. We continue. The bank will be asked to accept 10 million ₦1 shares as consideration for 1/2 of the present overdraft. Please, what is the present overdraft?
45 million.
45 million. What is 1/2 of the 45 million?
22,500.
What is 1/2 of 45 million?
22,500. 22,500. That's half.
That is half of 45 million. Okay, good. It means that overdraft is a debt. Is that not, please? A current liability, a debt. A debt is being converted to equity. Recall, we explained that reconstruction might involve asset revaluation, introduction of new capital to the business, conversion of debt capital to equity. Look at it now. An overdraft that was 25 million naira is being converted to ordinary shares that was 10 million naira. The bank will be asked to accept 10 million naira, 10 million ₦1 shares as consideration for 1/2 of the present overdraft. That means if this proposal is accepted, 22.5 million overdraft will be converted to 10 million naira worth of shares. Let's go and treat this. Let's treat this in our book. We just come here and say, come here and say, bank overdraft converted to shares. Converted to shares. How many shares? 10,000 shares. Price 1 naira. Value 10,000. We have treated this. Don't forget, out of 45 million overdraft, we have converted 22.5 million to ordinary shares. Let's continue with the question. Let's continue with the question. All right. The shareholders. Okay, wait. If this proposal is acceptable to creditors, the shareholders have indicated their willingness to take up a further 30 million naira, a further 30 million ₦1 shares for cash. That means the existing shareholders are willing money to the business. They want to bring in, they want to 30 million naira worth of shares. and the balance remaining outstanding to the bank will be repaid from the proceeds of this issue. Let's go and treat this. We'll come here. New shares. New shares. 30 million at a price of 1 naira nominal value. Total 30 million. That will appear in the share capital account. That means total year 20 million plus 10 million plus 30 million. We have 60 million shares. The naira amount $60 million naira. Now, bank will now receive 25 million cash. Is that not? Is that not, please? Bank will receive balance due 22.5 million. Not 25, sorry. 20.5 million. Bank will receive 22.5 million. That is the balance remaining. Yeah, the balance remaining. The balance remaining. Is that not, please? Remember that 1/2 of the overdraft has been converted to ordinary shares that are worth 10 million. The examiner says, out of the proceeds of the new shares, bank will receive the remaining balance. And the remaining balance is 22.5 million. I want to assume this is clear.
It's clear.
Okay.
Okay.
We continue with this again. Here on proposal C. Okay, this is where we stop. Okay. The directors are confident that if this proposal is put into effect, profit of 40,500,000 per annum will be earned for the foreseeable future, of which 2/3 will be paid out as dividends and the remainder reinvested. We need to treat this. We need to treat this because bank is now part of the shareholder, and as a shareholder, the bank must collect dividends. Now come here, let's treat that aspect. Look at it. Reconstructed profits, reconstructed company,
press,
reconstructed company's profits. Please check your speaker. 40,050,000. Examiner says 2/3 of this will be dividend. Please compute dividend amount, dividend 2/3. Please compute 2/3 of 40,500,000. What do we have? 2/3 of 40,500,000. Please compute.
27 million.
That means 27 million will be paid to shareholders as dividend. The balance will be retained. Have we? Differences, please look for differences. Retain profits. How much?
$13,500.
13,500. 13,500. Okay. No, our concern here is because Able Bank is now part of the shareholder, then Able Bank should also collect part of the dividend. Can now say dividend due to Able Bank. The total dividend is 27 million. How much of this 27 million will be due to Able Bank? We can now go back here, look at it. Dividends due to Able Bank. If you look at the new company, Able Bank has 10 million shares. And total number of shares in the company is 60 million. You can go back to it. Look at it, please, in the share capital we prepared. Look at this. We have total shares 60 million. Out of this 60 million, bank will have 10 million shares. You can now compute this because dividend is shared based on the number of shares you have. Now I can now come here and say dividend to Able Bank is going to be 10 million shares over total number of shares, 60 million shares in the company, multiplied by dividend to be distributed.
27 million.
27 million. How much will Able Bank collect as dividends?
4.5.
Thank you. 4,500,000. So we can do our summary of all our calculations now. We can do a summary of the calculation. And this summary is very necessary anyway. Can do summary. We have 3 proposals. Proposal A, proposal B, and proposal C. We have now. Now is year 0. Now means year 0. Then we have year 1. We have subsequent year. Subsequent years. Now for proposal 1, Able Bank will collect 30 million naira immediately. That is nothing in year 1, nothing in subsequent year. For proposal B, Able Bank will not collect anything immediately. Year 1, Able Bank will collect 36 million. And nothing in subsequent years. For proposal C, Able Bank will collect immediately 22.5 million. That is the remaining balance. Then a year later, Able Bank will collect dividends of 4.5 million. Subsequent year, Able Bank will collect dividends. Dividend in subsequent year. Because the profit is for foreseeable future. In as much as the company is making profit, then Able Bank will continue to collect dividends. This is solution to part A of this question. The part A says, calculate what Able Bank will receive under each of the proposals. So if you take proposal A is immediate liquidation of the company. Able Bank will get 30 million immediately. If you take proposal B, Tayo Limited takeover. If the company is taken over by Tayo Limited, Able Bank will receive 36 million, but that will be in 1 year's time. If you take proposal C, Able Bank will collect 22.5 million immediately in year 0. Then a year later, Able Bank will collect dividend of 4.5 million. Subsequent years, Able Bank will collect dividends, provided the company is making profit. All right. Any question, please?
Okay, sir. In this scenario now, sir. Hello, sir.
I'm listening. Yes, I can hear
Yes,
you.
Scenario now, because I believe at the end of this thing, you will make a conclusion at least, or suggestion as your summary, or as from your summary. And then which among this one, which proposal do we at least supposed to take?
Okay. I'll answer you in 2 ways. First is that the part A of the question only says calculate what the bank will receive. It didn't say we should advise which one they should take.
Okay,
It
okay,
only
thank
said
you.
calculate what bank will receive under each of the proposal.
Okay,
Now, if
okay,
you now
thank you.
look at the B part of the question, that question you were asking is what the B part is now asking us to do. Okay. How that is clear, sir?
It's understood, sir. Thank you.
So let us answer that question in part B. Now that will take me to the B part. The B part of the question says, examine the relative financial merits of the proposals from the viewpoint of Able Bank. Relative financial merit. Relatively, which one is better? Relatively, which proposal is better? To answer this question, we need to go to present value, because for proposal A, the cash flow is in year 0. For proposal B, the cash flow will be in year 1. For proposal C, we have cash flow in year 0, cash flow in year 1, cash flow in subsequent year. That means we cannot compare these three proposals until we bring all of them to their present value. If you are trying to compare two proposals with different time period, you cannot compare them until you take all of them to their present value. Because of the differing period, you can't compare. So to answer B, the relative financial merit of the proposals. Okay, let's take it here. Let's move to the next page. B, relative financial merits of the three proposals. To examine the relative financial merits of the proposals, comma, it is necessary to determine the present value of each proposal. using a discount rate. Using a discount rate of 15%, i.e. bank lending rates. If you look at the notes to this question, so that you can know where we are picking the 15% from. Look at the notes. The question say, please note. Note. Assume that the bank earns 15% on all its lending. That means the bank lending rate is 15%. And that would represent the bank discounting factor. So you come here. Calculation of present value. We have our cash flow. We have the year, the cash flow, the discount factor is 15%. Then we have the present value. So we go to proposal A. Proposal A, this is year 0. The cash flow is in year 0. Now, amount involved is 30 million. Let me take it as a round figure, okay? Okay, this is 30 million. Now, discount rate at 15% year 0, this will still be 1. 1 multiplied by 30, the present value is still 30 million. Is proposal 1. Or proposal A, proposal B. Proposal B. The cash flow will happen in year 1. That's year 1. This cash flow will happen in year 1. Amount involved in year 1 is 36 million. Please, what is the discount factor year 1 at 15%?
Is 0.869.
Okay, nous allons work it ourselves. 0.869. Then find the present value, 31 point what? 31.3 approximately. That's 1.3 million. Then proposal C. We have two cash flow here for proposal C. We have year 0. Bank will collect 22.5 million. Let me close this. This is for B. Close this. Bank will collect 22.5 million. Year 0, the discount factor will be 1. Amount is still 22.5 million. For proposed. Then, see proposal C, we have bank will collect dividends in year 1, and bank will still collect dividends in subsequent year. So this is year 1 to infinity. This is the sign of infinity. Year 1 to, this is the sign of infinity. Bank will continue to collect dividends. Look at the dividends in year 1 and for the foreseeable future. That means that cash flow will happen in year 1, 4.5 million. And that cash flow will continue forever. In as much as the company is collecting, in as much as the company is in existence and is making profit, then Able Bank will continue to collect dividends because Able Bank is now part of the shareholders in the company or shareholders of the company. So 4.5 million. Now, how do we calculate present value of a cash flow for year 1 to infinity? Yes, how do we calculate the present value of a cash flow from year 1 to infinity? Please note. Okay, we are listening.
1 divided by the discount factor.
Thank you. 1 divided by the discount factor, multiplied by the cash flow. One divided by a discount by a discount rate, please. Look at it. Present value of perpetuity is equal to the cash flow multiplied by 1 over the discount rate. Over the discount rate. If I'm to calculate this now, our cash flow is 4.5 million. Then times 1 over discount rate. Discount rate is 15%, 0.15. Please work this out. What is the present value of this?
30 million.
30 million. Just put 1 over discount rate over 0.15. This will give you 30 million. That means total for proposal C. That will give us 52 million. 0.5. Yeah, thank you. The cash flow that is transferred. We have gotten the present value. We can now go ahead and examine the relative financial merit. Now, which proposal is better relatively? Which of these proposal is best now?
C.
Proposal C.
Okay. Any other opinion? If you have to comment on this now, so we have to comment. Look at the expected comments. Proposal C offers the highest present value. However, it is the most risky option. If the reconstruction fails, the bank okay. If the construction fail, able bank we only receive 22.5 million. Proposal B is marginally better. That will be your comment. Marginally better than proposal A. If you compare proposal B, it will give us 31 million present value. Proposal A, 30 million. Just small margin. Proposal B is marginally better than proposal A. However, there is default risk. Tayo Limited may fail to pay 80% in 1 year's time. In 1 year's time. As a risk. That will be our comment. Proposal B, proposal A. Proposal A offers the lowest present value and it is the least risky option. What should the company accept now? Yes. Which of these proposal should the bank accept?
Proposal A, as that one has the least risky option.
Okay, bank should choose A. At least collect your 30 million and just move on. So I just forget about the whole transaction. Is anybody agreeing with is it Eno, right? Am I correct, Eno?
Yes, sir.
Is anybody agree with Eno? All right.
There's no business without risks.
So who is speaking, please?
Oh, Hussein, sir.
Hussein, okay?
Yeah.
I agree with you. There's no decision without risk. So which one are you going to advise the bank to accept?
Is A, C, to remain in the business, to remain on the dividend.
Okay, the bank should take the IS.
Yes.
I can see comment from Nusa, which is very intelligent. This will depend on the bank's priorities and risk appetite. And that's a good comment anyway, that you might not be able to say which one the bank will do. Just comment that the final decision will depend on the level of risk, the management of the bank. Let me go to that comment and write. Oh, excuse me, please. The final decision will depend on the management of Able Bank and on the level of risk. On the level of risk, the bank, on the management, of able bank. And on the level of risks, the bank is willing and ready to accept if the bank is willing to accept higher risk, then the bank should select proposal C. The bank should go for capital reconstruction if the bank is willing to take the higher risk. Alternatively, if the bank is trying to minimize its risk, then the bank should look at alternative A, immediate liquidation of the company. Alternative B is not reasonable at all. Alternative C is not reasonable at all. Alternative B is not reasonable at all. All right, do I have any question, please? Any question, please? That's fine. You can look at these assignments, Heritage PSC. Of course, we can't solve this now. We have treated 2 questions on this topic. That's fine. So please, let us look at this assignment, Heritage PSC. Let's try to attempt this assignment and revert. After the class, I'm going to reshare the working notes, including the assignments. All right, we shall be closing on these notes. Any question? At our next class, we move to the 3rd topic. The first topic we have treated corporate failure. Our second topic, business reorganization and capital reconstruction. We are done with that today. By God's grace, next week, we shall be looking at finance success. What are the sources of finance? If there's no question, then I will be checking out of this classroom.
Where is this assignment? Is it in the pack that we were given?
You are going to have it now, don't worry. Okay. It's on this material now. It's also in the pack anyway. So after the class, we are going to reshare. Yes, the assignment is in the pack. It's also available on this working notes. So after the class, we are going to reshare. All right, let's have a blessed evening. May God give us a better understanding. Good night.
Good night, sir.
Yeah, good
Thank you.
night.